All right, let's talk about an ETF that's been making a ton of noise lately, ULTY. You've probably seen it mentioned. It's this super popular high-yield fund that makes a pretty incredible promise, getting a paycheck from your investment every single week. But is this promise really as good as it sounds? Today, we're going to dig deep into the YieldMax Ultra Option Income Strategy ETF and figure out if that weekly payout is a golden opportunity or if it's actually a golden trap. And that's really what it is, isn't it? It's this beautiful idea of your portfolio just printing cash, hitting your bank account every Friday like clockwork. You can see why ULDYTS has built up such a massive following. It taps right into that desire we all have for consistent, easy cash flow. It feels like you've stumbled onto some kind of financial cheat code. And that's the million-dollar question, right? Is this whole thing for real? So that's what we're going to do. We're going to peel back the layers on this fund, look right past that flashy, giant yield number, and see what is really happening to an investor's money. Okay, let's get into it. So first up, let's just break down why ULT is so dang popular. It all comes down to a really powerful and very simple promise that just clicks with anyone who's looking for income from their portfolio. I mean, if you spend any time at all on social media or investing forums, you've seen these exact lines. You've heard them. These are the rallying cries. They're simple, they're powerful, and honestly, they're incredibly tempting. It makes you feel like you're getting your money back so fast that the price you paid, well, it doesn't even matter anymore. And you can see why it works. You look at an annualized yield that's been hanging around 85%, sometimes way higher, and you add that weekly payout schedule, and the numbers themselves just seem to scream, buy me. On paper, it looks like the perfect income machine. Okay, so now let's pull back the curtain a little bit. How is that huge yield number actually calculated? Because this, right here, is where the beautiful dream starts to show some pretty serious cracks. Now, to understand the illusion, you just need to get one simple thing. Yield is just math. It's the total annual payouts divided by the current share price. And that current price part, that's the key. That's the sleight of hand. Because when that price goes down, the yield percentage can go way, way up. And that creates a super misleading picture of what's actually happening. So just look at this example. Let's say the fund is paying out $7 a year in cash. Well, if the share price totally collapses down to just $6, the math suddenly spits out a yield of over 100%. It looks absolutely fantastic. But it's only telling you about half the story. Because here's the context they don't put in the headline. What if you bought that share for $20? Well, now it's only worth $6. You've lost $14 per share. So even after they hand you that $7 payout, you're still deep, deep in the red. The giant yield you're seeing is a side effect of a catastrophic 70% drop in your original investment. And this mathematical trick, it leads us directly to the fundamental mechanical problem with how ULT works. It's a concept called capital erosion. Capital erosion is pretty much exactly what it sounds like. Instead of paying you from actual profits the fund has made, it's really just giving you your own money back, piece by piece. And all the while, the total value of your investment is shrinking. You know, that seed corn analogy is perfect. You get to eat a meal today, sure, but you've just destroyed your ability to grow any food tomorrow. Now, this all happens because the fund's strategy, a synthetic covered call, creates what's called an asymmetric risk. Basically, the game is rigged against you. When the market goes up, your potential gains are capped. You could only make so much. But when the market goes down, oh, there's no cap on that. You eat the full loss. This is such a great way to think about it. You get a little bit of cash for renting out your car, which feels awesome. But if the person who rented it gets in a wreck and totals it, that little rental fee isn't going to come close to covering your massive loss. You took on all of the real risk for a very small, limited reward. And if that skewed risk wasn't enough, there are a couple of other things quietly draining your money that you won't see advertised on the flashy label. Let's start right here. The expense ratio is 1.3%. Now, just for some context, a simple S&P 500 index fund might charge you like 0.03%. This fee is more than 40 times higher. It's a guaranteed drag on your performance year after year before you've even accounted for any of the investment's ups and downs. And what about that weekly income? Yeah, it's weekly, but it is anything but stable. The payouts can swing wildly from one week to the next. Look at this, 10 cents one week, 20 the next, then down to 5. It makes it almost impossible to actually budget if you were hoping to use this for real-life expenses. So much for reliable income, right? It's like having a job that pays you in lottery tickets. Okay, so this brings us to what is arguably the single most important metric in all of investing. And it's the one that gets totally lost in all this hype about yield. I'm talking about total return. Total return is the only thing that gives you the full, honest picture. It combines the change in the share price, your capital gain, or your loss, with all the cash distributions you've gotten. It answers the only question that really matters at the end of the day: is my wealth growing or is it shrinking? Simple as that. And when we look at ULT through that lens, well, the report card is not pretty. Since it launched at around $20 a share, the price has just cratered, down to about $6. That is a 70% loss of your capital. And all those distributions, as nice as they feel, haven't come anywhere close to making up for that brutal decline. And this really highlights the danger here. Focusing on yield by itself is like judging a restaurant just by the free bread basket. Yeah, you might get a huge, delicious starter, but if the main course is terrible and it's way overpriced, you still had a bad meal. You're ignoring the most important part: the actual health of your core investment. Okay, so if ULT is this potential trap for a long-term investor, what is a person who actually needs income supposed to do? Are there smarter ways to get it? The good news is, absolutely. There are plenty of alternatives. You've got more stable monthly income ETFs like GPI or SCHD. You have classic dividend growth stocks. You even have simple things like bond ladders or CDs. The key difference is that these strategies are built for sustainability. They focus on protecting your principal first, while generating a reasonable, reliable income. So what's the final verdict here? When you boil it all down, ULTY isn't necessarily a bad thing, but you have to know what it is. It's a highly specialized tool. Think of it like a gas-guzzling sports car. It's flashy, it's thrilling for a short ride, but it is not the safe, reliable family sedan you'd bet your financial future on. And that's really the final thought I want to leave you with. An investment's ability to pay you cash is tied directly to its underlying health. The goose can only lay so many golden eggs before it just keels over. If the fund itself is shrinking, eventually those payouts are going to shrink too. So take a hard look at your own income investments and ask yourself that tough question: are you collecting golden eggs from a healthy goose, or are you just eating the goose one bite at a time?